Hi guys, welcome back to another video. In the last video, we talked about spot transactions and forward transactions, right? So we know that spot transaction and forward transaction is two separate things. Okay. Now we're going to talk about swap. So what is the meaning of swap? Swap is simply doing both of these things together only. Okay. Swap is doing spot transaction and forward transaction together only in one single deal. So we will just have one single deal and we'll do both spot transaction and forward transaction in one single deal. Okay, let us take an example from the book itself. So the example that the book considers is that imagine that there is an American bank, which is Citibank. Okay, this is an American bank. So this bank receives $1 million today. Okay, this bank receives $1 million today, and they don't need this money for let's say 3 months. From now, from today's time till the next 3 months, they don't need these $1 million. So what are they going to do? They have two options. They can let this money sit in the bank idle, or else they think, why not we invest these $1 million today? We will invest it in euro. कहाँ पे इन्वेस्ट करेंगे हम $1 million को that we have, we will invest it in euro for 3 months. We are going to do this investment for 3 months, and then they want to earn some return. They feel like if they invest in euro, they will earn 3 months के बाद में some return. ठीक है? So what they need to do exactly is that in today's time they will convert this $1 million that they have, the $1 million that they have, they will convert it into euro. First off, they will convert it into euros. This conversion that will happen today will be a spot transaction. Am I right? Hena, this will be a spot transaction. And what will happen after 3 months? So if we talk about the period of 3 months, so what is going to happen after 3 months have passed? So after 3 months, the money that you had converted in euros, you will convert these euros back into dollars. है ना, you are going to convert these euros back into dollars. So when you convert your euros back into dollars, this is the part of forward transaction. This is the part where forward transaction takes place. So they could do these as two separate deals also, right? They can go to the market today for the spot deal, है ना, and then separately go to the market for again for the forward deal. So today they'll invest dollars in euros. This will be a spot deal, and after 3 months they'll again go to the market and then they'll convert these euros back into dollars. So these can be two separate deals also, right? But that means that when you do two separate deals, this means that you have to pay a brokerage fee for both the times that you have been to the market. So every time you go to the market, you have to pay the broker a certain fee for the conversion of your money. So you have to pay your brokerage fees two times. So to avoid that, okay, you don't have to pay your brokerage two times. Okay? What they can do is that, for example, they'll pick up a bank. This is the Deutsche Bank. They'll pick this bank, let's say in Germany. Okay, they'll pick this bank in Frankfurt in Germany, and they'll say that do one thing for me. I have $1 million today. Do both of these transactions for me as one single package. So they'll go to the Deutsche Bank in Frankfurt in Germany and they will say that do one thing, do both of these transactions for me in one single package only. I want to do both of these transactions today only. So doing this transaction in a single package means this is a foreign exchange swap. What is this? This is a foreign exchange swap because you're doing it in a single package only, which means that you will have one deal, है ना, one deal to look after. There is only one negotiation that you're doing, and you're also paying lower fees because you don't have to pay twice, and you're getting the same result that you would have when you would have done this two times. Okay, one time you would have done the spot deal, and the other time you would have done the forward deal. But right now in a single package, you are doing a foreign exchange swap because you're doing both of these simultaneously, and you are getting and you're paying lower fees as well. We can say that the forex swap is nothing but a bundled package of spot and forward in one transaction only. We are only doing one single transaction and we are getting a bundled package of both spot and forward. Now if someone asks you that what is the swap rate, because we are doing a forex swap, right? So what is the rate at which we are doing this deal of a bundled package? So swap rate is the rate, or we can say the difference between spot rate and forward rate used in the swap. So whatever spot rate we are using in the swap, whatever forward rate we are taking up in the swap when we are doing it, whatever the difference is between these two, this difference is my swap rate. This difference becomes my swap rate, and this rate is expressed in yearly basis. Okay, this rate is expressed in yearly basis. Why do we express it in yearly basis? Because we want to find its value over a period of 1 year. And the swap rate, I hope you all have understood that this is the price that I'm paying for doing the bundled deal. So whenever I'm doing a bundled deal, this is the price that I have to pay. Let's talk about foreign exchange futures. What are futures contract? So futures contract is a kind of forward contract only, but this is more standardized first thing, and this is traded on exchange. Now, what do we mean by standardize? This is what we have to understand. So, okay, when two banks are doing a forward contract, for example, we are doing it in a private manner. Okay, we are doing it in a private manner. So we can decide any kind of amount. है ना? We can decide upon any kind of amount. We can decide what currency we have to use in forward contract, what two currencies are we using in the forward contract. We can choose any date after 3 months, 6 months. We can choose any date also. Okay, so this is flexible. When two banks are doing it among themselves privately, this is more flexible, and this is very custom made because the two banks can put on the table their needs, and this is custom made. This is flexible. But when we're talking about a futures contract, this is like a forward contract only, but everything is fixed in advance. Everything is already fixed in advance by the exchange. Everything is fixed by the exchange in advance only. So you cannot customize it because it is fixed in advance by the exchange. You will have to buy whatever is available. Okay. Now we have a question that where are these futures traded? Where are futures actually traded? Where are futures traded? So the most famous place is called as the IMM, which is International Monetary Market. So IMM is the International Monetary Market where futures are traded. Okay, and this started at around 1972, and since then futures are being traded. And similar markets also exist in places like New York and London. Okay. Now, our next question is that what currencies can you trade futures in? So we are about to answer that what currencies can we trade futures in. So we can only trade very specific currencies. First is Japanese yen. Then we have Canadian dollar. We have the pound, the British pound. We can trade Swiss franc, Australian dollar also, and euro. So we can only trade futures in these currencies that are mentioned here. We don't take into account any other currency except for these currencies. Okay. Like I also mentioned, there are very specific dates that are available. You cannot choose any date that you want. There are I think that there are only 4 specific dates per year, which are not important for you to know, but just remember that there are very specific dates. So if you need a delivery on some random Tuesday, let's say in February, then futures is not an option for you. You can do a forward contract, of course, but you can't do a future contract. Okay, so these are some of the rules, and there are some other rules as well. So there is also a daily limit on how much the exchange rate can fluctuate, the fluctuation of exchange rate. So there is a daily limit on that. Because we want to prevent any kind of swing that happens, you also have to pay a brokerage commission and post a security deposit also of around 4% of the entire contract value. So you have to pay brokerage fees and also a security commission as well. So to avoid any kind of confusion, let us quickly discuss the differences between futures and forward in a very simple manner. So what are the differences? So in a forward contract, you can put in any amount that you wish to put in. Okay, you can put in any amount that you want, but in future contract, standard sizes are available, and you have to choose among those standard sizes of amount, okay, that you can put in that contract. And like I said, future gives you only 4 dates per year, because only in these particular dates you can do your contract. Maturity is only for these 4 dates, but in a forward contract you can choose again any date that you agree on. Forward happens between privately between two banks or between banks. This happens privately, but futures happens on an organized exchange. So futures happen on an organized exchange. Then, as we know, futures only picks some selected currencies. Not all currencies are part of futures, but like we studied in forwards can pick up your forward contract can pick up any currency. You can include any currency in your forward contract. Okay. Now forward is done by smaller firms. Mostly forward is done by smaller firms, but futures contract is done by large size banks and firms. So this is done by large banks or firms. Then can you exit early from a futures contract? The answer is that yes, you can. You can exit early from a futures contract. You can sell your contract back at any time and you can exit. But can you exit easily from a forward contract? The answer is no. It is very difficult to exit from a forward contract. So one big difference that you can see of futures over forwards, one big advantage of futures over forwards is that you can sell the future contract at any time. So you can sell the futures contract at any time, even before the delivery date. You can sell your futures contract at any given time before the delivery date. You have to go on the forex exchange and you can sell your futures at any time. Forward contract is a private contract and you're logged in for a particular period of time. It's much harder to get out of it, right? And one disadvantage of futures that we see, future contract is also kind of expensive over a forward contract. Future contract is much more expensive, and this is less flexible. As we have seen, this is less flexible in terms of amounts and dates, right? Now let's move ahead and come to foreign exchange options. We have already discussed foreign exchange futures. Now let's talk about foreign exchange options. Now this is the most interesting one, okay? So see, with a forward contract or a futures contract, with either of them, what happens is that you must complete the deal. You are in an obligation that you have to complete the deal. No matter what happens, both the sides that are dealing in a forward or a future contract, they have to honor the contract, because they have signed up a deal and they have to honor the contract on the delivery date. But an option is a different thing. Option tells you that it gives you the right, okay, it gives you the right, you can buy or sell, but you are not forced to do it if you don't want to, okay. It gives you a right to buy or sell, but you are not forced. You are not obligated to do it if you don't wish to, okay. So you only pay a small fee upfront, which is called as premium. So this small fee that you pay upfront is called as the premium. So premium is usually 1 to 5% of your entire contract value. Whatever contract value you have, the premium is only 1 to 5% of it, 1% to 5% of the entire contract value. And you just have to pay this premium to get the freedom of your choice. Okay. So you have the right to buy or sell, but you're not obligated to be in the deal. We have two types of option. The first type of option is called as the call option. The call option tells me that I have the right to buy a currency at the agreed price. So I have the right to buy a currency. I have the right to buy. Notice that I have the right to buy a particular currency at the agreed price. And what does a put option tell me? Put option tells me that I have the right to sell a currency at an agreed price. So a call option tells me that I have the right to buy a currency at an agreed price, and the put option tells me that I have the right to sell a currency at an agreed price. So there are two styles of option also. Apart from these types of option, we have two styles of options. So these two styles of options that we have are European option and American option. So under the European style of option, you can only exercise it on the specific stated date. You can only exercise this on a specific stated date. But under the American style of option, you can exercise it anytime before the stated date. So this is basically more flexible because you can exercise it on any given date. So this American option is more flexible for us. Then we have something called as the strike price. So the strike price is the price at which I have the right to buy or sell. Whatever price I have the right to buy or sell, that particular price is called as the strike price. Let's discuss an example really quick. So there is an American company and there is an European company, okay. So the American company wants to take over the European company. The American company basically wants to buy the European company. So to do this, in order to do this, they need to pay a certain amount to this European company, because it is buying the European company and it has to pay this amount in euro, right? It has to pay this amount in euro. Now what happens is that there is a problem actually, okay. The problem is that the American company has made a bid. जैसे कि they entered a market and a lot of other companies were aiming to buy this European company. So they all have put on a bid, but they don't know if their bid will be accepted or not, because there might be some other American company that bids higher than this particular company and they get the deal. So whoever bids higher actually gets the deal. So they're not sure if their bid would be accepted or not, because they're not sure if their bid is the highest or not. Okay, so they're not sure about it, but they eventually have to pay in euros just in case they win the round and their bid is the highest. They will have to pay in euros. Okay, but they're not sure about it till now. So if they go to the market and if they buy euros today, okay, if they buy euros today, they go to the market, they buy euros today, they'll go to the spot market. First thing, that they'll go to the spot market. But if their bid fails, let's say that their bid failed, they did not get the deal, their bid failed, then they're stuck with these euros that they've bought, है ना? And they don't need it anymore. They are in no need of these euros anymore. But what happens if they enter into a forward contract? Because we have already talked about a forward contract. So what happens? You don't have to, in a forward contract, you don't have to receive the money today, or you don't have to make the payment for the money today. You don't have to make the entire payment. So if they enter into a forward contract to buy euros, and in this case, if their bid fails, what will happen now? Their bid fails in this case, but they still have to buy the euros. Why so? They have to, because in a forward contract also you are legally obligated, है ना? You are legally obligated to buy. So like we discussed, that if I go to a bank and if I tell the bank that I need 100 euros, but I need it 3 months after today, I don't need it right now, so I'll get it. I'll have to take these 100 euros after 3 months. I can't tell the bank that, hey, listen, I don't want this money anymore, you can just keep it with yourself. We can't do that, because the bank and I have agreed on a forward rate also, na. We have agreed on a common rate. The bank has also done some adjustments on its end, and I have also done some adjustments on my end. So we are legally obligated to do this deal. But there is an option also with me. Yes, there is an option of option also. And this option is call option. This option is a contract, right? We have a call option. What do we mean by the call option? So when we opt for a call option, what happens under it is that the American the American firm, the American company that was trying to take over the European company, gets itself under a call option, and in this case, they have the right to buy euros only if they need them. Only if they need them. They are not legally obligated, because under an option we are not legally obligated, but I will still have the right to buy these euros if I need them. Only if I need them. I Okay, so listen here. If my bid fails also, if my bid fails and I don't get to take over the European company, I will not exercise my option. I will not exercise my option. I have that right. I can choose whether I want to exercise my option or not. And in this case, I'm not going to exercise my option. The only loss in this case I will have is that I will lose on the small premium amount that I had paid upfront. Okay. So the only loss in this case is the money that I had paid as premium. Okay. Now, this is the very reason why options exist, because options give you a lot of flexibility. When you know the future is uncertain, you don't know about the future as such, and you know the future is uncertain, and you don't know if you'll actually need the currency or not, then option gives you a perfect way out, right? And in this case, if I ask you that who bears the risk, so if I ask you who bears the risk, what I mean is by who will be accountable for the risk or who will pay for the risk. So the maximum loss that the buyer can have, if there is a risk, so the maximum loss that the buyer can have is going to be the premium that he already paid. So the maximum loss that can happen to me is the amount of premium that I had paid. That's it. And what happens to the seller of the option? Imagine you are the seller of the option, okay? So if the buyer decides to exercise, they decide that they want to exercise, and the seller must fulfill the contract. In this case, the seller has to fulfill the contract because the buyer decides that they will exercise their option, so the seller is bounded to fulfill the contract. So the seller takes on the risk in exchange for receiving the premium. So why is the seller taking the risk? Why is the seller taking the risk? Because the seller is getting premium, and the buyer, the maximum loss that can happen to the buyer is only the amount of premium that they will pay to the seller. And the risk that the seller is taking in this case is to only receive the premium, and they are not sure if the buyer is going to exercise their option in the future or not. So there is an uncertainty, but both of them are safe. Let us summarize what we have done till now. Okay, what are the instruments we have discussed? Let us summarize them really quick. So we talked about spot. Spot is the exchange currency right now. Spot is the exchange currency right now. We know that. Okay, the settlement happens in 2 days, and we know that the spot is the exchange rate that is prevailing right now. Okay, the everyday transaction is spot. The second that we talked about is forward. What is forward? We lock in a rate. है ना? We lock in a rate today itself, but we do it for a future date. In forward, we lock in a rate today, but we do it for a future date because we don't want the money now. A forward is more customized. We know that this is customized, and this is a private deal between the two parties. Okay, and both sides have to honor the contract. Both sides have to honor the contract. They can't back out of it. Then we talked about swap. What is swap? So swap was that we do spot plus forward in one bundle itself. We do spot and forward in one single bundle itself. That was swap. Okay, banks do this mostly to save on the fees. They don't want to pay brokerage twice, so they do swap deals. Then we talked about futures. What are futures? So future is also like a forward contract only, but this is more standardized. Like we saw, futures contracts are more standardized. They have fixed sizes, they have fixed dates, and they only trade in specific currencies. Okay, and it is easy to exit from a future contract. We can easily exit from a futures contract, but we can't do it that from a forwards contract. Okay, and lastly, we talked about options. So options was the most flexible. This is the most flexible because we only have to pay a small premium and we get the right, but we are not obligated. There is no obligation. We are not obligated to buy or sell. This is perfect when we are not sure if we'll actually need the currency or not. So we are not in any obligation. Okay. So you have to revise all of these transactions and revise all of these instruments really well. And if you have any doubt, just put it in the comment and I'll resolve it. Thank you so much.